So now we have customer groups, portfolios. Wow, we are in business. So we no, no, yeah, I have the example, Mrs. Johnson. Yeah, the RSP. So we have that portfolio, and I would like to have a more in-depth look at that portfolio. So I go into Mrs. Maggie Johnson. I don't click on that. If I want to click on it, I will have my 6 funds, and I will have a view in which I have some information, but not all. I will have information about the mutual fund. I can choose. It will not be the same database as in the mutual fund, but it can go. It can be pretty good, but not the best. You see, it's different. You have the Morningstar and stuff like that for each and every mutual fund. You can have the basics here. You can have the risk analysis. So you are in that view with each and every mutual fund. But that is not what we do. That is the view for mutual funds. We want to have a broader approach because we want to have a portfolio approach. We don't want that, so we go back by clicking on that. I go here, and then again, you guessed it, right click, and then portfolio reports. So you have those portfolio. You have the snapshot, you have the X-ray, you have stock intersection, comparison, not now, and the portfolio summary report. We'll begin with the portfolio summary report. It's the fastest one. We are onto the portfolio, and we are, as you can see, it's a summary. It's very, very clean. This one is better than the mutual fund. We see the portfolio value. We have 6 mutual funds, $10,000 each, or $60,000. The average fund MER, I love that. They made a mean, an average of all the mutual fund, and the MER of each of everyone is 2.2 on average. The estimated annual fund expenses for the new rule, the portfolio yield as a dividend, the benchmark used, it's not the best, it's the S&P 500. If you want to choose that benchmark, okay, just 1 second. If you want to change the benchmark here, you go here, and we will edit the portfolio, and we will quickly go in the report option and just go and see one thing, the S&P 500. We go there, and I suggest to you to use as a benchmark the average GIC. Cash or bond doesn't make a difference, but I suggest to you to take that as a benchmark. And now we do that again. We go in portfolio, we go in summary, and you will see that it is changed. Of course, yes. So you see here, average GIC. Why I do that? Because it is if you take the S&P 500, it's obviously faulty because you don't want to compare a portfolio to the index 500. And if you try to compare to a portfolio made of different indexes in the same type of balance, you will almost all the time fail to successfully beat it over time. If you are able to do that, perfect, great. But it's very, very difficult to beat the market, especially in a portfolio of markets over time. So what we want to do is to beat the GIC, to beat the inflation rate. So it is easier, but you do as you wish. So we see here the portfolio summary, the bond analysis, the world region. It's a summary. And you see on page 2, you have the GIC, very smooth, but you have your portfolio. So you see a portfolio has a dent at the beginning because of 2008, 2009, but then it takes off, and it is nicer if you do that than if you do something else. You can try it at home, and you will see why I do that. At the end, you see the holdings, the 6 mutual fund, you see the percentage of asset, the 1, 2, 3, 5, 10 years return, the MER ratings, and the risk level. So a very nice overall report for a portfolio with the disclosure of each and every mutual fund here. And all the disclosure, of course, at the end. That's a quick report. So that was this one, the portfolio summary. If we go at the portfolio snapshot, so the portfolio snapshot obviously give you more than the summary. So you have more detail, more analysis. It's a nice compromise for me, for my taste. It's what I like the most because the summary, it's a little bit much summary. Some people would like it to be more summarized, Me, I like it because you have some numbers, you have some statistics in that, you have some meat to put your tooth into, and I think it's pretty graphical. The top is a lot of colors, a lot of graphics, so it's enticing. And you have your equity style box, you have your fixed income style box, you have your holdings, of course, and your best time, your worst times, and stuff like that. And and then you have on the third page all the data, the point on the risk reward scatter plot. So you have all those statistics. Even you, if you want to go nerd, you even have your price earning, the price to book ratio, and the valuation multiple of your different the aggregation, if you will, of different mutual fund into, and even the return on equity and the net margin of the companies that are included in the mutual fund that you have in your portfolios. It's a little bit more nerdy, but not as much as it is a bit more nerdy. So if you are that type of person, you will love it. If you look at it and you frown your eyebrow like that, so I would suggest not to go there. But I would suggest to go a little bit deeper because it's good to have some basic analysis. Okay, that is the second portfolio report. And then you have, if you didn't like the second one because there was too much statistics, the X-ray gives you the whole thing. The X-ray gives you the whole everything that they have. They don't hold back, and they give you all the information, all the statistical data to almost to be to be stick to your stomach. On the bond analysis, they even break down the maturity. They break down the credit, the score, credit quality breakdown of the score. They give you the duration. They give you the top 10 countries. They give you the top 10 underlying holdings of the mutual fund. So let's say in that particular portfolio, what you will have the most is 1.18% overall. If you had like 100 of the TD Bank, and the second corporation you will own the most will be 0.93% of the Oracle Corporation, and so on and so forth. So it's very detailed, and you have your trailing return, 3 months, 6 months, 1 year, 3 year, the best and the worst. You have your return there. Of course, the risk return is there, but they always put more information. You have your risk return statistic, the standard deviation, the mean, the Sharpe, this R square, all those things. So that part, I would say that it is way better than it was with Paltrack. It can be very technical if you want, less if you don't want to. So that was the third one. And last but not the least will be the comparison. So now I don't remember what I have put into example 2 of Maggie Johnson. I haven't reviewed it before doing that example. So I go here, we go in portfolio report, and instead of we go is here in portfolio comparison. So we go into portfolio comparison, and you need to when you do that. And of course, you can change here. You can put the client's name, your name, and the firms and everything. You don't have to. And the comparison is here on example. And usually what you do is on the left, you put the one that is the past. Let's say example 2 was the past from a competitor, and the RRSP is the future, the one you are proposing. So it is 1 versus 2. And then like for the security report, you can add a lot of things. You can add the fund summary report. If you click that, you will have all the summary of all the mutual fund included in the first and second portfolio. If you click portfolio X-ray, it will give you more, and it will give you one of the things that can be interesting is the stock intersection. You saw that maybe rapidly when I clicked for this report. I will leave it there. The risk reward scatter plot and all those things, I will leave them there for now. We have seen almost all of them, so it is okay. And what I want is I don't want aggregation. I just want individual portfolio. I don't want to aggregate at this point. And I will generate the report. So now you see the report in landscape, and we have 16 pages. I want to do something real quick, okay? I will go here, and instead of landscape, I will put that in portrait. And just to see if it changes the number, a quick question I was having in my mind, if it has the same number of pages. You see, that's what I thought. So it was 16 pages in landscape because it takes more space. And if you go portrait, it will just be 12 pages. So if you can do that from time to time, I will do that in slow motion, okay? I'm there in the builder, and I go back completely at the end, and you always have the choice of page orientation. At first, it was on landscape because it was my default. If I generate the report on landscape, it can be nicer on the eye, but what happened is it takes more space, and it is 16 pages, so it may have a better outlook, but it takes more space. If I go back and I click portrait and I generate a report, I say 4 pages, so that's not bad. It can be a plus, or it can be a minus, because you can say it's too condensed. So again, your choice. Here what I see is, whoa, okay, on example 2 on my left, I have an average fund MER here of 1.45. I don't remember what is in that fund, so I have an idea. And here it is 2.20. So we have a higher MER, but we'll see what is about of course, the rate of return. We can see the mix. Is that comparable? Fixed income here is 31%. Here, of course, it is 43%. So it's not the same mix. We have more fixed income on the right than we have on the left. US equity here, wow, we have 46% of US equity here and just 14%. So it is completely two different proposition if we were to do a proposition. We have seen here the style box. We won't dive into the details, but if you look at the style box here, it's very, very different. Okay, but instead of having just the dot on the one square, we can see more that those numbers are the percentages. Those numbers are the percentages of the assets that are contained into each and every square. Let's say, for example, that this here, that portfolio has 36% of the asset of that portfolio are into large and growth companies, and just 17% is into large and value companies, and 34% are into large and blend companies. And if you add everything, you have 87% of that portfolio that is into large companies, of course. And we continue. We can do the comparison here and there. I won't go there. It will be a little bit long and tedious. We can do that with, of course, the same thing. Here we have the Americas 85%. Here it is 80%. So geographically, looks a bit like the same. Greater Asia 4.78, 6.5. That's not where it is very different. The trading returns that we have here. So let's look at the big picture. Ooh, okay, it will be rough. If it will be a proposition, it will be very rough. Here the 5-year return here is 11.29%, and here the return is 6.26%. So it's tougher. The benchmark here is 10% on 10 years. Here it's 7%, not the same benchmark, of course, because two different portfolio. And we can see here the risk return. So the standard deviation, let's look at the 5-year. That part is not, if you look correctly, 1 year is here. 1 year benchmark is here, but the 1 year portfolio is there. So the 1 year here should be in the middle. So that statistic of the 1 year standard deviation here, it is here. The 3 year is 7, and the 5 year is 6. So 6% of standard deviation for 5 years. Here for 5 years, I have 4%. So it's less risky a little bit. And then we can see all those things, comparison. What we have here. In this one, we have CI American Value, CIBC NASDAQ, of course, dynamic bonds. It's very, very different proposition. So we had the first 3 pages, it was comparison, head-to-head, everything different or similar about the two portfolios. And now we see the stock intersection. That's a nice add-on since PaulTrack. That is on Maggie Johnson, the portfolio called Example 2. which stocks she owns the most. So in her example too, she owns the most Apple stocks at 3%. Not bad. Why is she having so much Apple? Because the CIBC, the CI, the Dynamic, and the McKinsey, those four funds, each of them has Apple in them. I like it very, very much, and it is the only way to see it. It is with the stock intersection. I think it's very powerful, especially if you have a customer that is at maybe 5, 6, 10, 15 different mutual fund at many, many different company. You can see how they think they are diversified, but have everything at different places. We see Microsoft, they have Microsoft at CIBC Nasdaq, American, and they have Amazon. Amazon is they just have in the one fund, Alphabet 2 fund, and then Visa 3 fund, and like that. It's not maybe the best example, but it is an example for the example 2. So we can see in the RRSP portfolio that the most she has is in the TD Bank at 1.18%, and because it is in those two mutual funds. The second is Oracle, the third is CN, and she has Canadian National in 4 different mutual funds, and then CBS Health in just the one. And so we can see it's not very concentrated, because at the 5th position, it is 0.7% in one company. That's not an issue at this point. So again, it is made of the same way that we saw before. You saw the benchmark. It was selected auto bench by category. I do not suggest that because it's very rough, but it can, when you compare, if you don't compare the rate of return, that is not bad. But when you compare the rate of return, sometimes it can be a little bit difficult, but it is, again, your experience and your choice. And you can go here and update the preferences. It will bring you up to your personal options, and you can go in the report option. And if you do that very, very often, you can select the one you love the most, the one you will always do, and those little arrows here are to put, let's say you want to always talk about underlying the holdings, or you always want to have the correlation matrix in those report. Okay. So you can put that in forefront. So you can say, me, correlation matrix, I like it, and I always want to have the 3-year of the 5-year correlation matrix, but I want it to be first in my report. So you click that and you put that there, and once you have saved it, not on this spot, but the next one you will do, it will be there by default. So that's a great time saver.